Go for it. So my name's Dave Marcus. Again, I've known, just my quick background, I've known Todd and Stacy since they were a 3-person company. I know it doesn't look like I've been doing this as long as they have. They've been doing it much longer than I have. And now you guys are what, like 350 or 400? Something like that. I don't know. Anyway, pretty large. So it's always a treat for me to come in here and teach some classes. And I've been doing this, I remember when I used to never say this, but now it's 17 years. So I've seen it go up, I've seen it go down, I've seen it go up, and now I see it go up, and who knows where it's going to go. But condominium financing has always been something that has been a little unique, and I would actually argue that a lot of people in the lending industry don't even really know much about it and rely on their underwriters to kind of make the decision. So I feel it's important that whatever lender you guys decide to use can provide you with the information up front, so this way you could coach your clients through the necessary things before they even go under contract. And the goal of this class too is not to make you guys lenders, right? We want to arm you with enough information where if a client asks you a question, or if you're walking into a specific condo, you've done a little bit of due diligence before as a buyer's agent, let's say, to be able to coach them and give them the pros and the cons of this complex. And as a listing agent, obviously to know how to represent this property properly in the MLS, so you don't get a ton of buyers that aren't going to qualify for it. You know, there's no reason to list a non-warrantable condo in MLS and say FHA financing available. Because if you do that, you're going to get a ton of offers for people that will not qualify.
Right.
And that's one of the challenges. Is you're going to see in this presentation, one of the slides that I go over here in a minute, is just because the name of the complex doesn't have condominium in it, does not mean it's not a condominium. And oftentimes we see that townhouse is specifically said in the title. So we often see that this is not a condominium, this is a townhouse. And there's different lending guidelines, and then when the lender gets the loan and the lender does their due diligence, they find that no, this is 100% a condominium, and now we have different rules, is really what it comes down to. So throughout this, please feel free to interrupt me if you have any questions. I think I'll know 98% of the answers. I may not know all of them, and we're going to go. So this is going to be a little bit interactive, so if you guys don't want to participate, tough. You have to participate, just a little bit. We're going to skip over a few of these initial slides, and we're going to look at this one right now. And this is pretty basic, just to get you guys involved here. And the question is, how do monthly fees compare with similar nearby condo complexes, and what service do they include? So this is not as big of a issue here in Denver, right? Because when you have a person looking for a condo, they want to look maybe in Aurora, they want to look in Parker, and there's a limited amount of condos. But if they go into downtown Denver, where there's a lot more condominium complexes, this becomes a bigger question. So what would be one of the reasons, we would want to do our due diligence on this for our clients? I'll help you with this. It's Monday. It's the first question. So one of the reasons is, and we see this a little bit of the time, not often, but some of the HOAs actually include heat and AC. Some of them include cable and internet and TV. So for instance, if you've got a condo A, that the HOA, let's use downtown, is 500, and then you have condo B, the HOA is 400, your client might look at this and say, $500 is a lot of money. I could get the same, assume these things are really close, square footage, quality, like-kind quality, but now the only thing we see is the difference of the HOA for $100. As an agent, if you've done your due diligence and you're like, well, hold on, let's step back. Guess what? You don't have to pay for hot water, you don't have to pay for your heat, you don't have to pay for your AC, you don't have to pay for cable, you don't have to pay for internet, you don't have to pay. So all of this is thrown into this HOA, so this $100 additional HOA now is really a good deal, if you think about that. So it's just something to think about. So going back to what the legal definition of a condominium is. So we're going to start basic, and then we're going to get into the granular stuff. Again, I would not rely on what the project name is. Okay, so in this, just because it says a condo doesn't mean it's a condo. We want to make sure that we read the description. So in order to be a condo, there's something called a master deed that the developer actually registers with the county. And this master deed essentially defines that it's a condo. If that does not exist, this is not a condo, okay? Verbal description, you know, we don't want to accept that. We want to make sure we look at the legal. Generally speaking, if it's not lot and block, it's going to be a condo, generally speaking. And then we could get really granular on that. And I'll tell you this, the MLS, more often than not, we see that what's listed in MLS is inaccurate. So I would not rely on that either. Okay.
So where is this master deed? Is it part
It's
of
registered
HOA
with the county.
Okay, the county.
Yes.
Okay.
And it is it's part of the HOA docs, if you will.
Okay.
It's separate from the CCRs, but it's literally registered with the county. So if you do a search on the county records, that's where you'll find it.
Okay.
What are owners associations basically there for? We're going to go into that, and here's where I talk about the master deed. It's AKA is called the Declaration of a Condominium, and it's registered with the county. It's a public record. Just like you can find out like what mortgage is on a house in the county, you can do that as well at the county level. Okay, and that's usually the best way to discover this is number one, pull title if it's going to be your listing and see what the legal is. Number two, look on the county records, and that's how you'll find out.
Can the legal description be wrong? As far as condominium or townhouse? Depending
on where you find the legal, yes, I've seen legals that are incorrect.
Okay.
Without a doubt.
Mm-hmm.
So what the master deed does is converts one parcel of land into a number of individual properties with common elements, is essentially what it is. Each condo owner automatically becomes a member of the association, and the main purpose is to control the common elements, is essentially what this is all about. Okay, so let's talk about some of the details. And the handouts that I gave you are designed intentionally not to have every slide on there. If in fact you want the slide presentation afterwards, we'll send that to you, but it's designed not to have everything on there. So this way you can add a little bit and also not have to worry about every little detail. The rules that govern a condo are called the bylaws, and those are recorded on that master deed. Okay. Now the bylaws are not the same as the CC and Rs, covenants, conditions, and restrictions. And again, I don't want to get too in the weeds with this, but I want you to know that there's a difference here. Okay. And we can go into a little more detail in the end. Each person that buys one is going to receive a copy of this from the developer, and generally maintenance fees are allocated among owners according to the percentages of the master deed. So, you know, depending on the size of your unit is going to affect what the HOA dues are. You know, if you've got a 1,000 square foot unit and your neighbor has a 3,000 square foot unit, it wouldn't be fair that the HOA fees are the exact same, right? And I know you have a listing in Landmark, and I'm sure you've seen with those, there's a big difference whether you're in the penthouse or you're on ground floor. Big difference, I'm sure, in what those fees are. And your property taxes, as we know, are not going to be included in that. So, let's talk about taxes and insurance here. This is, taxes are not unique to condos, but insurance is, and this is something that you can definitely help your clients with without being an insurance broker, right? I always defer in everything that I do saying I'm not a financial planner, but I know this. I'm not an accountant, but I know this, or I think this. You should always go. But just giving you enough information. Your tax is going to be based on the assessed value, as you all know. And the association is going to be responsible for insurance as well as the individual. Okay? So this is why I asked how many folks have been in real estate for less than a year and 3+, because this presentation covers everything. So some of this, again, might seem a little simple, but some of it may not to others. The master insurance policy, as we know, for most folks, is going to cover everything on the exterior, and then your individual policy, or something called HO6, is going to cover the interior. Okay?
So is the HO6 also for townhomes?
Depending on the townhome, depending on what their master insurance policy covers, yes. So some townhomes, you're going to get a similar condominium complex policy because the master policy covers almost everything they need to. And other townhomes, you know, you're going to have a homeowner's policy as if it was kind of like a freestanding house.
Okay.
So it all depends on what that master insurance policy covers will determine what kind of insurance you need for yourself in a townhome.
Okay.
This is big, some red flags here. And again, your insurance person is going to be able to help you this, but coinsurance. Is anybody familiar with what coinsurance is? So coinsurance basically says that the insurance policy is going to cover X, which is not all of it, and the individual is responsible for Y. So coinsurance basically says you're not 100% covered for any loss it could be. So let's say in this particular policy, it's going to cover up to $50,000 in water damage on the interior of the unit, right? Now we know if we have a flood on the inside from, let's say, a washing machine or something, you could probably cause more than $50,000 in damage. If you have $100,000 in damage, your insurance policy is only going to cover half of that. The individual has to come out with the other half. The good news here is the lender typically will not allow a policy like this. So this would be another reason why that condo would be non-warrantable. Okay, and this is both on the individual policy and the master insurance policy. Okay, one of the other red flags is actual cash value. So, do we all own houses in here? Okay, so actual cash value here is typically something that we see on roofs. This is how insurance companies get away with saving money on roof replacement, right? So if you have, I live over in the DU area. I have to get my second roof done in 4 years. My insurance company loves me, but we have full replacement cost. If it was actual cash value, they're going to take what it costs to replace that roof, they're going to take depreciation, and then they're going to give me the remaining. As opposed to full replacement cost, what it takes to replace that, they add back in depreciation, and then I get essentially 100% what it's going to cost minus my deductible. And flood insurance. You know, it's not too often we see condos here in Colorado in floodplains, but there are some. And if you have at least $250,000 per unit, then that's the maximum allowable or permitted flood insurance for a condo, so you're 100% covered. Again, these are just things for you to look out for, to advise your clients when looking at condos. Okay, new construction. Is anybody showing new construction condos in here? We're going to have a lot of them come to the market soon. Am I wrong in assuming that? It looks like there's about 15 cranes in Denver, and I think they're building all sorts of condos with mixed-use bottoms, right? So in the Denver area, I would say that the new condo is going to be something that we see a lot more of in the coming 1 to 3 to 5 years, depending on how long it takes. So these are general statements here, but depending on the type of financing, some financing might require that the entire complex be completed before we're going to allow certain types of loans. Okay? Now, one of the cool things that developers do, is they've figured this out, that it could be almost impossible to finance a condo if this is the rule, is they'll create phases. And now we look at individual phases, and now there's a percentage of the phase, depending on the type of loan you're going to get, that's going to be required to be completed before you're going to get certain types of financing, whether it be FHA, VA, Fannie, Freddie, jumbo financing. And everyone has different rules. We're going to go into that in a little more detail here in a little bit. Again, I basically said that. The reason we want to do this is to protect the investment, and that's from Fannie, Freddie, Ginnie. You know, if we start offering loans to buildings that are not complete, let's go pre-recession. pre-recession, was anybody familiar with what happened in Florida? Okay, so I'm gonna let you guys in. So in Florida, I was actually working in the mortgage business pre-recession in New York, and about half of my company were investing in condominiums pre-construction in Florida. And we all know what happened is these values were going up. People were flipping these condos before they were even breaking ground, and then we went bust, and these condos never got built, right? So this is one of the reasons why Fannie, Freddie, Ginnie, and other mortgage-backed security companies will not offer financing until either a phase is completed or the whole project is completed. So pre-construction financing, generally speaking, the builder has to have at least 15% of the units sold, okay, before. FHA is going to require 30%, and then 50% for Fannie and Freddie. Now, this is not the end-all, be-all, but again, if we do this in phasing, then it makes things much easier. And then to make it one step more complicated is we can't have more than 50% of the 30% be investor loans when it comes to FHA. And that 50% rule is going to be pretty much the same for just about all of the institutions, Fannie, Freddie, Ginnie, VA. That 50% number is pretty critical. Now there are going to be ways that we can get around this. And I'm going to talk about that here in a little bit. Okay. A long closing timeline can tie up payments, which is typical. Interest rates, we don't know what's going to happen, and there could be contingencies that could all create issues on new construction. So what are some of the pros you think of buying pre-construction? And if you've got that in your cheat sheet, don't look. What do you think some of the advantages of buying pre-construction would be?
Getting to choose where you want to be.
Exactly. How about something else?
Interior, just like a new build house.
You get to choose all your finishes, sure. Anything else? How about from a financial standpoint?
A little bit less to do it.
Typically when you get in pre-construction, right, you're going to get a better deal. If you're in phase 1, it's probably going to be a lower price point than phase 2 or phase 3 or phase 4, so you're going to get maybe more of a discount. What else might be a benefit to buy pre-construction? Okay. Design, value, you have more time to save. Some of the other things too, sometimes often builders will allow you to pay parts of your down payment in increments, okay? Maintenance fees typically on a new building, you don't get charged for the first year that you live there when the condo has, generally speaking, before the HOA has been turned over to the owners, you generally get to live there for a year maintenance free, which is kind of nice. Some of the negative things is you don't get to see it before you buy it. I bought a house sight unseen, new construction, and I thought it was going to look one way, and I was like, well, that didn't come out the way I thought the floor plan was going to look. I thought the house was going to be facing this way. I thought the rooms were going to be bigger. Some people can actually see that, like you guys were saying earlier. You have buyers coming into your condo, and the way it's set up right now, they can't see it's 2 rooms, right? But if you stage it properly, they can see that this could be used. I'm one of these people who cannot visualize from a pair of plans. And these builders do a really good job of showing you these fancy pictures and 3D models. I'm horrible. So, if you're good at that, you could get a bargain, but you may not get what you think you're getting. I know my folks were just in town. We were talking about that they have a condo in New York, and as soon as it was done, my mother looked at this. She goes, I don't want to live in this. It felt a lot smaller than what it felt like on paper. So one of the other things is it frees up it does not free up your capital. So if you get in pre-construction and you have to put down X amount on contract, your money might be tied up for 2 to 3 years, depending on how long it takes to build that out. So you've got to be willing to say, is this money being tied up for 2 to 3 years? Okay. And then the other piece of it too is, if you're going to get financing, what are interest rates going to be? Do we know what interest rates are going to be like in 2 or 3 years?
Yeah.
there might be a preferred lender on there that'll lock you in for a year. But if you had a preferred lender that locked you in for a year and you were supposed to close in September of 2019, he locked you in or she locked you in a much higher rate than we offered in September of 2019. Now, we didn't think the market was going to go that way, but there are some pros and cons to both. Some additional considerations, what happens if you're forced to buy it even though the financing gets delayed? Your income changes. You might want to consider putting some contingencies in there. Now, I know that generally most new builds right now, the contracts are written by the developer's attorney, and you can't change those. So this is if you have the ability, you're working with maybe a smaller kind of mom and pop developer. Maybe you're doing something that's only got 30 or 40 units. You might be able to do that. You want to look into the track record of the builder. That's another piece. Is this builder reputable, or is this a guy who's brand new and this is his first project and we don't know how his financing is behind the scenes? Is he going to potentially go belly up? Is he counting on all these pre-sales to fund the project? And then it could take 2 to 3 years to do that. All right. So one of the other key questions here is, what percentage are renters? Why is this an issue? Or why is this a benefit?
Well, obviously renters are not going to take as good a care of the units.
Mm-hmm. So something about pride of ownership. They don't really give a hoot. It's not theirs. Why might this be another issue?
Vacated properties as well.
Mm-hmm. So in a down market, if people are losing their jobs and renters are in there and their rents are high and all of a sudden they can't afford it, what are they going to do? They're going to probably walk away. And then that person that owns that now has to pick that up. So from a financing standpoint, that's a higher risk for lenders, and that's why we require that X amount of units be owner-occupied. We've done the research, and we find that if X amount of units are owner-occupied, there's a higher likelihood that this condominium complex and the strength of the A2A is going to continue to be as high as strong as we want it. And from financing too. So financing condo, there are going to be certain guidelines for each loans, minimum credit score requirements, down payment requirements, and then the warrantability issue. So let's talk about warrantability. What is this warrantability word? What is this big word? What is the simple definition of warrantability? I need somebody. Do we need coffee? Can we get some coffee in this room, please?
Is it some kind of guarantee?
So
that. Well, I don't know.
So I'm going to make this word because we hear about warrantable condos and non-warrantable.
Yeah.
And literally I'm going to
Eligible for purchase.
Exactly. I'm going to make this super easy. A warrantable condo, you can get financing on. A non-warrantable condo, it's very difficult to get financing on it. It's all it really is. So generally speaking, if it's warrantable, you can get pretty much any financing out there. If it's non-warrantable, you have to come up with creative financing. And there are some banks that specialize in this non-warrantable type. Now, I want to ask a question here. Is it necessarily bad to buy a non-warrantable condo?
I would guess there's better deals to be made when you have such a low group of people because they're looking mainly at a cash deal or special financing.
Mm-hmm.
So I would have to assume that makes the deals better on the condo.
So it's a great point. So from a perspective, you might be able to get a better deal on something that's non-warrantable because financing is difficult. So there's a smaller pool. So simple supply and demand states that, hey, if only this amount of people want to buy it, we have more room to negotiate, right? So great point. What about a first-time home buyer that has never owned a house before and is in love with this condo because it's got all the bells and whistles, but it's non-warrantable. Is that something that we wanna advise our clients to proceed with? Is this something that we wanna maybe put the brakes on? Is it something that we wanna tell them no? It's a trick question.
My answer, in all honesty, would be
Yeah.
let's talk to the lender and see if we can make it work.
Okay, and that's perfect. So this is what I'm gonna go, and this is Dave Marcus's personal view on this, right? Why is it non-warrantable? Let's figure that out first, right? Because if we know why a lender doesn't really wanna lend on this, it could be something really petty that's not a big deal to the future homeowner. Or it could be something really major that could cause disaster. So a perfect example would be, it's right there in number 1. Are there any pending lawsuits, right? So a perfect example of why these would be non-warrantable is the HOA is suing the developer or the builder for structural defects. This is a very common one, okay, when we see litigation. So, I'm a first-time home buyer, you guys are representing me. We know that this is the problem, right? Now, act like I'm your child, right? I'm 21 years old right now. It's my first home, I know diddly, right? I'm your baby. What are you gonna say to your baby?
Walk away.
Let's go look at something else.
Yeah, totally.
Yeah.
And why is this? Because this could be a nightmare that could go on for years.
Yeah.
The litigation just between the HOA and the developer, I mean, could cause millions. And guess what? The developer might have deep pockets. Guess who's paying for the HOA side? Each individual homeowner. So,
So it really doesn't matter whether the condominium is the plaintiff or the defendant, just that they're involved in litigation, what is enough of a red flag?
well, it does make a difference if they're the plaintiff or the defendant. It does make a difference, okay? But what is the litigation? When it comes to construction defect like that, I don't care who you are. It's gonna cost a ton of money on both sides, and that's one of those you walk away from. There's very few lenders that will do that. We will go on an individual basis, and I know some lenders around town will as well. We will look at what that construction defect is. And if we believe that that construction defect is not really an issue, where let's say all of the gutters on every single unit were installed incorrectly, so they're not draining, okay? Not as big of an issue as there are cracks in every foundation on every unit, right? That's major. So it all depends on what that is. Okay, so we're going to keep this non-warrantable thing, and is it good to advise your client? Okay, so how many units are rented to non-owners? So this is a big thing. As we discussed earlier, Philip said that, you know, if you're a renter and you have a high renter concentration, there's a high percentage chance that these people don't care. You know, pride of ownership. They're not going to take care of their place the same as, well, we shouldn't assume. Most people probably do not take care of their place the same way they would if they owned it, right? And how easy is it to resell your house or resell your house if there's limited financing options, right? So from that perspective, you know, we want to be careful on that. Now, if you're an investor and you've got deep pockets, right, and you're buying in a place that's heavily filled with renters, you've probably taken this into consideration. You might be getting this condo for a significant discount, and you're okay with that, so it might be a good purchase for you, right? So it's not always bad. What percentage of the HOA is behind on dues? This is another big one, right? There's a reason why we shy away as lenders if there's a high delinquency rate on HOA dues. Why is that?
Because if they
Can't
can't,
maintain.
yeah, if they can't collect, the rates are
Yeah,
gonna
I mean,
go up.
if we have a big hailstorm like we do, and you know we need to put new roofs on, and we need some of the funds from the HOA to help, because we don't have enough reserves, and we are 15% delinquent, we're probably gonna have a hard time collecting that money to put a new roof on. So that's a pretty big one. How much does the association keep in reserve? Okay, that's another big one. Non-warrantable generally says if 10% of our budget for the year is not put in reserve, then it's going to be non-warrantable. And now, this is a tricky one because you can have an HOA that has $1 million in reserve right now. Okay, $1 million in reserve, and let's say their budget is $1 million. Right? You're going to say, well, we've got a full year of reserves. Of course, this would be good. And you know what your lender's going to say? You know why? I learned this the hard way a few years ago, right? Because I said, well, we got $1 million. And, you know, I've been doing this again 17 years, so I'm not perfect, but I learned the hard way. So if the dues that we collect on an annual basis, we don't have 10% going into reserve, then that's going to make it non-warrantable, because what can happen in theory is I have $1 million claim, all of my reserves just got used up, and I have nothing going into reserve. It's the same concept that I use with my clients that have a lot of money in the bank but make no income. And they say, Dave, I could buy this house 5 times over. Let's be simple. I'm buying a $200,000 house and you have $1 million liquid in your bank account. You know, you should be a pretty safe investment. And I tell these clients, I know, but the reality is I don't know you're going to go out and buy a yacht tomorrow and have no money. A lender typically wants to know, it's the same thing with reserves, it's better to see somebody bringing in income regularly than having a lot of income in reserve. It's the same concept with how much is going into reserve every single month. So just because their reserves are strong doesn't mean that it's going to be warrantable. And that's a pretty big one that snags people a lot.
So I have a quick question
Sure.
for you. You know, like when it comes to FHA loans, how do we check if the condominium is FHA approved?
You know what? I'm so happy you asked that because Paul taught me this sweet thing on this Apple, because I'm not an Apple guy. Watch this. Oh man, it was supposed to be a 4-finger swipe. I had it all pulled up. Paul, I'm looking bad. Ah, man, I had it all pulled up. I was gonna be so proud of myself. All right, so let's see if I could do this. Ooh. So I'm skipping ahead here. This is one of the last slides, but this is a secret, which is not really a big secret. But the coolest thing is there's these websites right here, and all I got to do, and I'll send these to you later, and I'll make you a deal. You could even just Google FHA approved condos, and you'll go right here. So I'm going to go to this website, and all you do is right here, and let's see if I could get in there. And in this, less information is more information. And what I mean by that, if you put the specific condominium name in there, if you have one little thing out of place, you're not going to find it. So we recommend that you put the state and the county. You start there. You could put maybe the zip in there.
Okay.
And then you search that way. Okay? And the same thing exists for VA. Okay? It's really, really easy. So you don't have to rely on, you can rely on your lender, but you don't have to. You could just, oh sugar. Oh sugar. Hold on. I'm going to get it. I'm going to figure it out.
Thanks for coming today, everybody. Includes our presentation.
Oh, I was so proud of myself. History. It's got to be under history. Show history. Oh, I gotta call Paul. Paul to the rescue. I tried to get fancy and I lost my presentation. He showed me this 4-finger swipe and I thought it was up. Oh.
Okay, here's your presentation, and are we looking for something else?
We got there. We're gonna get back. So that was the 4-finger swipe.
Yeah, I think just left and right, or I'm doing 3, I guess.
I'm so proud of myself. Thank you so much. Darn it! Thank you so much. Alright.
So those are actually their sites then, right now?
These are their
Third
sites.
Party? Okay.
This is FHA's site and that's VA's site.
Great.
And I'd be more than happy to send you the links. or literally all you have to do is Google FHA approved condos. You will go right to that site,
Okay.
or VA approved condos.
Okay.
And we will get more into that here in a little bit. Alright, so where was I? Okay, we're on warrantability.
So another question that comes
Mhm.
with it. So why some condos are not FHA approved? So like, is there a process that HOA
Yes.
needs to do certain
Yes.
things to? Okay.
Mhm. So they wouldn't be approved. The main reasons they're not going to be approved goes into the warrantability factor. Pending litigation, they don't have enough in reserves, one entity owns more than the allowable, or there's delinquencies when it comes to HOA dues. Here's something that's really cool, hot off the press, because today's October 7th. On October 15th, I'm getting ahead of myself, but it's okay. On October 15th, FHA is allowing for what we call spot condominium approvals again. So this went away for a long time, and what a spot condominium approval means is simply, if the condo complex is not approved via FHA, we can literally submit for just that single unit to get approved during our transaction, right? So we want to do our due diligence up front and just kind of get a condo questionnaire and make sure that all the things that we're going to need for it to be approved are approved, and then we can do that. The reason why a lot of HOAs, it's kind of a brutal process to get FHA condos approved, and it's costly and it's time consuming, and you know, when they expired, you know, HOAs just didn't have, I should be careful how I say this, but the board members of a lot of HOAs chose not to go through this process to get them FHA approved, which I personally believe ultimately hurts the value of your condo, because if there's limited financing, then your condo is only going to be worth X, as opposed to if there's a smorgasbord of financing that everybody can get, right?
Another question. I think you said if one owner owns multiple properties,
Mhm.
is there a limit on that also that goes, because there's a 50% rental, you know, to ownership.
Yep.
But is there also the issue with somebody owning too many, did you say?
Right here, right on this slide. This is, and it's going to be different for, so Fannie is generally 20%, Freddie's 25%, and then
Okay.
FHA is 10%.
Okay.
And then it depends on different different size condos. So if it's 10 or less, there's a different rule. If it's 11 or more, there's a different rule. But generally, you're going to be dealing with condos that are 10 or more units.
Okay.
So, mixed use is another issue. Mixed use, we're going to see this a lot more, right? Let's think about all of these walking malls. Let's talk about like Southlands, and let's talk about Streets of South Glen, and let's talk about everywhere. I mean, I think they're trying to do it in probably Castle Rock, I'm not familiar, and Parker, and there's going to be all these mixed use places. So generally speaking, 35% cannot be great. 35% of the building cannot be, no more than 35% of the unit can be used for commercial space, right, is what we consider. There is something that FHA allows for, and it goes up to, I believe, 49%, and it's live workspace. And this is a one-off. So if you see anything that has live workspace in there, there could be an exception where almost 50% of that could be used for commercial. And it's a lot of these new places that are coming up, you know, I don't know, with these shared workspaces, what WeWork, those type of places. So there's new rules that are coming out with those. Okay. I'm going to start going a little quicker just because I've got a lot of information. I've got 45 minutes left. I could probably sit here for 3 hours. Some things to include, again, we touched on this. One of the other pieces I want to go in a little more detail is, why are we so afraid of one person owning X amount, right?
Way too much power with
Exactly.
the board.
100%. You would never want to move into a place where your voice can never be heard because one person has the controlling share. A perfect example was, I almost purchased a place in Frisco a few years ago. It was a mixed use, and on the top there were 5 condos, on the bottom there were 4 commercial spaces. one person owned all 4 of those commercial spaces and 1 unit upstairs. That person made every decision because he had the majority of all this. I could never ever, if I wanted something done, there's no way that I would ever say, because he owned more than 50% of the whole building. So, needless to say, I did not buy there. Okay. We're gonna go through this. There's a ton of documentation needed for a project review and approval. These are just some of the documents that we're going to look for. So you're talking about CC&Rs, declaration of condo, budgets, financials, construction plans, engineer's design. There's just a lot of work that goes in, and this is one of the reasons why, if, for instance, a condominium approval has lapsed and it's more than 6 months, they have to go through the whole process all over again. So depending on how eager that board is, they might look at this and say, yeah, do we really want to go through all of this brain damage? You know? And depending on what the price point is too, you know, living in the Denver metro, you know, condos are more affordable than single family houses, but certain places, FHA loans aren't going to be as big of a deal. So they may say, you know what, we're just going to do conventional financing, and that's it. And it could be a complex where you've got a lot of cash buyers. Okay, this is, again, not always common sense, but it's common sense to me. Why do we require a reserve study? It's the same thing as an individual saving for the future, right? You know, if you're planning for retirement, a financial planner is going to tell you you probably should put X amount in an account once a month or annually or whatever it is, and it's the same thing with an HOA. It's a business, right? So we want to make sure our business doesn't go belly up because we don't have enough money in reserve. And 10% is the ideal number, if not more. Okay, so general ineligible characteristics. So unallowable concessions. So these would be concessions that builders are giving to buyers that don't conform to Fannie, Freddie, Ginnie, VA, right? So there would be larger concessions than what the standard allows for. And we see this sometimes in projects maybe in the mountains where they're giving away, you know, the kitchen sink because they haven't been able to sell these. Mandatory memberships. I don't know if you're going to run into this as much, but, you know, this would be maybe in like the 55 and older community on a golf course, that zone condo, that requires you belong to the golf course as well as be a member of the HOA. Hotel motel projects. Generally speaking, this word called condotel is not going to be eligible. Does everybody know what a condotel is here? Okay. So condotels are, do you know?
No.
Okay.
Sounds explanatory though. I mean,
Philip, take it over.
No, it just sounds like where part of the condo is being rented out on a nightly basis and then other people actually own and live in those units.
Yep. So almost 100% accurate. A condo hotel, very simply stated, is any condos where you can go and it's got a nightly rental rate with a front desk. So the owners can literally rent their unit as if it were a hotel. There's a front desk, there's maid service, there's linen service. We see these predominantly in the mountains. You know, there is financing for these. Generally, the financing is not that fantastic. Generally, you need 25 to 30% down, and I have yet to find any company that will offer a fixed rate mortgage on these.
Really?
Yeah, I don't know. First Bank happens to be fantastic in this space, so if you have anybody that's looking for a condotel, First Bank owns this space. That nobody beats them.
So I just want to make sure I'm understanding you correctly. If somebody wants to buy a place, say in Breckenridge, because I think the Marriott does this as well in Breckenridge is one example. So they could not get fixed rate.
As far as I know, the last time I checked, which is about 6 months ago, I don't know of any investors out there offering fixed rate mortgages for these type of products.
Wow.
Now, how do vacation rental come into play? Do they track that on a unit if a individual owner is using it for that?
So the VRBO or the Airbnb, no. So the Airbnb, I'm not a professional in this, but I know the Airbnb requires that it be your primary residence.
Okay.
VRBO is not, VRBO is vacation rental, right?
Yeah.
So VRBO, if you're buying a condo, as long as the bylaws allow for you to rent it like that, then you're okay. And as long as you're buying it properly, if you're using financing with the lender, and if you're using it as an investment property, you should buy it as an investment property. If you're buying it as a second home and you're using it as an investment property, I'm not the mortgage police, but there could be a gray area there.
So how does that affect other people trying to get into the complex? If there's
Well-
multiple units like that, or that's just, nobody tracks that?
Well, no. So if that is the case, then those are going to be listed as non-owner occupied. So those are going to be
Okay.
investment
Yeah, just that one.
units,
Okay. Yeah.
right? And whether you're doing short-term rentals or you're doing long-term rentals, you can still get financing on it as long as you meet the owner occupancy rates. It's not necessarily going to be a condo hotel because there's not necessarily going to be a front desk.
Yeah.
Right? So
Okay.
you could be okay there. Major litigation, we touched on property liens, single entity ownership, and then multiple unit dwellings. Again, timeshares, fractional ownership, houseboats. We don't have those out here. I haven't seen one on Lake Dillon recently, or Green Mountain Reservoir, or Aurora Reservoir for that matter. So we don't have to worry about that. And then commercial space, not exceeding 35%. I'm going to go through these real quick because I think there's better stuff that we can cover. But there's about 6 or 7 different types of project types we can classify. You have your established, you have your new, you have your detached, manufactured, co-op. We don't really see co-ops here in Colorado. We put this in here because you never know if that's going to change, but generally not speaking. And then PUD. So, for instance, in the project type, a PUD is going to be, your house on Highlands Ranch that has an HOA, but it's not a condo necessarily. Here's how we get around some of the issues when it comes to non-warrantability. Okay, so there's 2 types of reviews, and I printed these out for you guys to have. So there's something called a limited review and a full review, and this is the full one, and this is the short one. So generally speaking, if we have an issue with, let's say, investor concentration, or maybe reserves, we might be able to get around this by having a limited review. If we have to do a full condo review, then we're not going to get around that. A limited review exists for Fannie Mae and Freddie Mac properties, but the client has to be putting at least 10% down. So if it's an owner-occupied property, the client has to put at least 10% down, and then we can get a limited review. Now there's pros and cons to this. Going back to being, the trusted advisor for your client, right? What might make this non-warrantable, if we need a full review, might be a reason we don't want to buy it. Or, hey, if you're putting 10% down, we don't have to worry about that little piece over there that's making non-warrantable. We could still get you in, but as the trusted advisor, we want to make sure that, I'm making this assumption, we want to make sure that whatever's making it non-warrantable in this little bucket is not going to come back to bite them in the butt down the road, right? So even though we're not going to look at those features because the only thing we need is a limited review which ignores those features, we want to make sure that we're telling our clients that, hey, this could potentially come back to bite you, is what it comes down to. So to be eligible, again, it has to be, it has to be a completely finished condo project. And for an owner-occupied, it has to be 90%. A loan no greater than 90%. Any second home or investments, you have to put at least 25% down. And it requires much less information. And you're talking about a master insurance policy, HO6, and appraisal. There's a few little things on there, but we don't have to worry about all the things of a full review. Okay? Now, the full review process is much more in-depth. And what comes back to bite us in the butt when it comes to warrantability is the delinquency on the HOAs again, the 15%, the budget, the owner occupancy concentration, and sometimes if all of the common elements are completed, and what does the blanket insurance policy cover. So, it's a much more intense review and approval than the streamline or limited review. So, one of the things that you might market on a listing is eligible for limited review if buyer puts down, and you have to check with Todd, I don't know what's legal to put in the MLS, but if you know that this condominium complex will not pass on a full review because maybe there's some delinquency, the HOA is a little delinquent, you might be able to have your preferred lender, let's say, on a project like this, say, hey, listen, I know that my preferred lender can get financing on this project. Just an ace, kind of like, a little, ace in the hole for you. If you've got somebody making an offer and they're putting 10% down, or they're putting 5% down, you can come back and say, hey, listen, again, this is when the market shifts, right? This is when it becomes a buyer's market, And I don't know where we are in all price points, but I think it's shifting a little bit. But when you don't have 10 buyers coming to make an offer on a $250,000 property, and you only have one, and you need to get creative, this might be one of the things that you have is like, a little ace in your hole, so to speak, and say, hey, we know we can get financing on this conventionally if your buyer puts at least 10% down. Okay? Freddie Mac project types approvals are generally the same. They're a little more lenient on certain things, but there's basically the same process. There's something called a streamline when it comes to them, and it's pretty much the same thing as Fannie Mae. So we're just going to kind of go through this. Something that's a little different is there's something called reciprocal project reviews for Freddie Mac. So Freddie Mac basically will take, if it's approved via HUD, it's approved via VA, if it's approved via Fannie, Freddie Mac will take all of those. Okay? FHA will not. So let's step back for a second. Fannie has their own process. Freddie has their own process. FHA has their own process. VA has their own process. Okay. Generally speaking, if it's VA or FHA approved, you can go Fannie or Freddie. Okay. Freddie has stated that if it's VA, FHA, or Fannie approved, we automatically take it. Fannie has not stated that. Fannie says we still have our own approval process. Generally speaking, we're going to do that. When it comes to VA and when it comes to FHA, there's no such thing as a streamlined process or a limited review. Okay? It's a full review every time, and that's why we have the approved list, right? On the approved list, if you're on there, great. Starting October 15th, if you're not on there, FHA, we can do 1 unit approvals called spot approvals. There's something more like 150,000 condos that are currently approved in the United States. FHA estimates with this new approval process, we're going to be adding 20 to 60,000 individual units per year starting right now. So there's about 150,000 approved complexes, but they feel we're going to be adding anywhere between 20 and 60,000 new units per year, individual units. And I think what's going to happen is after we have a bunch of different spot approvals in a complex, it's going to make it that much easier just to get the entire complex approved. And I think that's the direction they're really going with this, to make it easier, because there's a lot of money, time, and energy spent to get a project approved. So I think, and this is my opinion, where this is going is it's going to make it much easier for FHA approvals to take place.
Well, that's what I was going to ask. If they do a spot approval on Unit A and it gets approved and then Unit B is for sale, will they look at Unit A and say, hey, we've already done a spot approval here?
I don't know the exact answer. You got the 2% I said. I said there's going to be 98%. I know. Just because this is new again, I'm going to say right now the way I understand the rule is, as an individual lender, we have to provide X, Y, and Z to get it. Now, if property A or unit A was approved, it's gonna be much easier for us to provide X, Y, and Z, right? And the other cool thing is, we don't have a ton of condos here. So if you're working with a bank that does a lot of business here, there's a high likelihood that they've probably already done a spot approval in that, as opposed to, I would say maybe a broker who doesn't have the ability to keep that in there, right? So, I don't know, but I think it would make it easier as we get down the road.
So it sticks with the property approval.
Just the unit, yes.
Yeah, with that.
Just that individual.
So when that owner wants to resell
Correct.
it.
Yeah,
It could
it's approved.
It's approved.
Yep.
Is the information on spot approval gonna be available somewhere? So we
As
have a
far as what the
client-
requirements are,
No, as far as how
Which
many
units?
are approved. So if we have a client looking at something that is not approved, can we go somewhere to see, it's got 4 spot
Mhm.
approvals? Is that, or not?
I have to get back to you on that.
Okay,
Because one of the requirements for spot approval
Yeah.
is you can't have greater than 10% of the units in the entire complex with FHA loans. So if you have 11% of the units in there that have FHA loans, you can't get a spot approval. So that's one of the other little nuances of this new rule. So yes, we are going to have to be able to tell
yeah.
what percentage of units are approved in there. And I need to get back to you on how. I would imagine that HUD's website is going to be able to provide us with this, just like we're looking up what's currently approved and what's not. I would imagine we're going to be able to do that 100%. And again, it's so new again that next week it rolls out, so we'll probably have 100% of the details then, as soon as it rolls out. Okay, we're going to skip over this one. All right, so there's 2 ways to get condo projects approved when it comes to FHA. The one on, I guess, my left, which is your left, is the general way we do this, right? We submit it to HUD for approval. This could take 2 to 6 weeks. Approvals last 3 years. There's a lot of paperwork, and it could be costly. The one on the right, you don't see as much. So most of your lenders here, your big ones, right? Your Fairways and your Guilds and My Bank and whoever else have something called direct endorsement ability, meaning the agencies have given our underwriters permission to make decisions without their approval. Right? So this is pretty big. Even though we have the ability to make decisions without their approval, we are now going to be on the hook for this loan for the entire life of the loan. If we do the process that's on the left, we're not on the hook. FHA will buy that loan all day long. If we do the process that's on the right, whatever lender approved that is now going to be on the hook for that loan for its entirety. This is why you're going to see very few lenders actually use that ability to approve these condos, right? Because they don't want to be on the hook for this loan for the next 30 years. It just doesn't make sense. Okay, I'm going to skip around for a second and go back to new construction. This is a good point. So in the beginning I had said with new construction financing, a certain amount of the project has to be completed, right? And then you're going to say, well, a certain amount of the project has to be completed to get financing. How are these people getting financing? What often will happen is on a new project, the developer will team up with a lender. And that lender, who's the preferred lender on that, has negotiated with the developer and essentially the powers that be within their bank to say, okay, since we're the preferred lender, we're going to expose ourselves, we're going to take more risk, and we're going to use this direct endorsement lender power to approve these prior to what would typically be approved. So this way we can get this financing. So when you are looking at new builds, even if you have a preferred lender, like the person you recommend, that you want all of your clients to get approved, right? Because we want all of our clients to get approved by our preferred lender, right? Because he's the best or she's the best. Your preferred lender may not be able to do this deal because the one that's actually working with the developer has made some exceptions and they're taking on more risk. So that's how they can get these loans done before what a typical lender would be able to do these. Okay, so you may have to use the preferred lender on that project because they're doing things that typically would not be done. Okay. Again, what are some of the ones that are easy? Existing conversions, 2 to 4 units, manufacturing, leasehold. Ones that are not, co-ops, condominium, hotels, timeshares, houseboats, we talked about this. Okay. With FHA, we are going to require a full review. The good news is if it's on the approved list, it's pretty easy. It's literally done. If your approval is going to expire, you should, or the condo should, re-up their approval either 6 months prior or up to 6 months post, right? So it'll be interesting to see what's going to happen with the spot approval. Phasing also allows us to approve projects and get people in when we don't have a completed project. And here's what we had discussed, our spot approval. So this is happening right now. No more than 10% can be FHA insured. And then when we get to projects less than 10 units, no more than 2 units can be FHA insured. Mixed use, this is what we were talking about earlier. Non-residential space may not exceed 35%, but I could go up to 49, and that's that live-work space, right? So if you get into one of those situations, it'll be pretty cool for you to know that, hey, we could potentially do this with an FHA loan if almost 50% is commercial and 50% is residential. Okay. This is a summary of FHA approved condos here. So the building must be approved, or the individual unit must be approved. Percentage of renters cannot exceed 50% with exceptions up to 65. It's very rare. Standard FHA borrower guidelines approved. Loan limits to play. Does everybody know what the maximum allowable loan limit for FHA is in the Denver, Douglas, Arapahoe, Jefferson County is? Anybody want to take a guess? It's pretty big.
500?
Well, that would have been
Higher?
525? 7.
550.
561,200. Pretty big. You know, the average price of a house out here, a condo is, I don't know. Last time I checked a year ago, it was somewhere close to almost $500,000. Somewhere in that ballpark. I mean, single family house, high 4s or something maybe. I think. So yeah, we can offer loans, FHA loans, pretty darn high. Same thing with VA. Same thing with Fannie and Freddie. So you could still get, you know, conforming loans up to 561 in here, 561,200. So some of the benefits of using FHA. Low down payment. The reality is you can do less with a conventional loan. This used to be a big benefit, but conventional loans, I mean, I have a product that requires 0 out of pocket. FHA, you can do some down payment assistance that requires very little out of pocket, but you know, the big benefit here is the non-occupant co-borrower. Okay? There are conventional loans that allow for that, but they're definitely more difficult to get done. We are more lenient with FICO scores and debt to income ratios. This is a big one because if you don't have a 620 FICO score, you can't get conventional financing. It just doesn't exist. And even if you have a 620 FICO score, your conventional financing is gross. Your interest rate is horrible. Your mortgage insurance is horrible. You have a 620 FICO score, you want to probably go FHA anyway. Manual underwrites. This is another big thing. Conventional loans, it's very, very rare to find anyone that's going to do a manual underwrite on that. A manual underwrite essentially says if the automated underwriting system will not approve it, we can bypass that and literally do it the old-fashioned way. Now, there are more strict guidelines when it comes to that, but we can get these approved. Some of the other benefits are shorter waiting periods when it comes to bankruptcies and foreclosures and short sales. Now, this isn't such a big deal now, right? Because when was the last time you heard of a foreclosure? Right? You know, let's rewind 10 years ago, and if you didn't know somebody that was going through foreclosure, it was a rarity, right? and now we're lucky enough to have this pass us. But you know, I'm just going to say that things are cyclical,
Yeah.
right? And I hope that we don't see anything too soon. But this is something to know and have in your back pocket down the road, because it will become something that we're going to be looking at again. I just had a client call me up, which was very sad, that is behind on her mortgage, and she's potentially facing foreclosure. And it's a situation where she can't work and she's waiting for her disability to show up, and it's very sad. And we're trying to help her out right now, but I haven't really seen that in a while. VA condo approval. I'm just going to put this up, but I am going to say this. The VA, believe it or not, even though they is anybody a veteran here? Okay. It wouldn't make a difference what's going to come out of my mouth anyway. If anybody online is a veteran, it's still the same. With that being said, the VA really will try to do anything in their power to help out their vets. They really will. The only unfortunate thing is they use like DOS. Right? Does anybody remember what DOS is? Right? It's like the original computer programming from like the Commodore, like 30 years ago. Right? Their computer systems are so antiquated that it takes forever. They literally, I think, still go back into like big file cabinets to find documents from 40 years ago. It's pretty crazy. But the VA Regional Loan Center, there's one here off like Wadsworth and is it 6th Avenue, I want to say. They're amazing, and they will do everything and anything to do this. They have their own approved list, which I'm going to show you the website at the end, and their list is actually I would say much larger than the FHA. Okay, and it's a similar process to get VA loans approved, but if we're trying to get VA condos approved, if we're trying to do that and we have a full package, we could submit it to the Regional Loan Center and maybe get that expedited. And again, they're going to try to do everything in their power to help out the veterans. So it's pretty cool. And once you're on there, I don't believe it's a 3-year waiting period. I think they last longer. Okay, so this just talks about if it's approved. There might be additional documents that they need. If they were approved, we could talk about what we need to get it reapproved, and if it's unacceptable, they'll tell us why it's unacceptable. Okay. Okay, there is not a limited review. This right of first refusal, this is a big one. This is one of the reasons why you will not be approved on a VA loan ever or condo. Everybody know what right of first refusal is? It basically just says that, hey, if you want to sell your condo, the builder developer has the first right to buy that before you can offer that to the general public. So if that is in any of the documents and the bylaws on the master deed, this will be an ineligible project no matter what. And again, there is no limited review, but the VA is pretty easy to get approved on the condos. This I'm not going to get into the weeds with. It's just certain fees they can't pay. The sellers don't have to pay them. Lenders have figured out how to cover all these fees for our clients. So back in the old days, essentially, sellers would say, well, we don't want to have a VA loan, right? Because back in the old days, the seller would be responsible for picking up certain fees on the VA loan. The reality is, lenders these days have figured out a way to absorb these costs so it never comes out of the seller's pocket. Okay? And here are our two databases. So, I almost got through this with 15 minutes. So what I want to kind of leave you all with in closing is some of the main factors that you should be aware of when it comes to what would make a condo eligible or not eligible, right? And this is where I said we're going to have that participation. We're going to see who is paying attention. Uh-oh, I'm getting eyes. I'm getting eyes over here. Somebody is not happy with this question. So let's talk about probably the four main things. Who can give me one of the things that we would want to look out for when seeing if a condo is going to be approvable or not approvable?
Lawsuits.
Lawsuits.
Mhm.
It's a big one. That's
Reserve-
another big one.
Reserves.
Reserves is another big one.
Percentage of rentals.
Love it. Percentage of rentals is another big one.
Percentage of individual ownership.
Boom. So if there are 4 things to take away from this right now, there are more, but I would say those are typically the biggest 4 that are going to cause you an issue with any condo. So we're talking about any potential litigation, what do the reserves look like, what does the owner occupancy versus investor look like, and what's my last one?
Individual ownership.
Individual ownership is really what it comes down to. So, look at that. We snuck through 14 minutes left. I am open to any and all questions. If there's something here that I didn't cover, because there's a lot that I didn't cover, if there's any specific situations you've run into that you want to ask me about, I am all yours.
Lawsuits.
Lawsuits.
Finding out if there are any. Is
Generally-
that in the documents, or do we have to go to public records? Or?
Generally speaking, the easiest way to find that out is to speak to the management company.
Okay.
The management company generally is going to say, in order to get that information, you have to get a condo questionnaire. If you get a condo questionnaire, they're going to want to charge you. So my first recommendation, especially from a listing perspective,
Mhm.
is, let's say Hammersmith. Hammersmith is a huge management company out here. You could call up, you could walk through the door, they've got an office in the tech center, I don't know if you're going to get someone, and say, hey, listen, I'm about to list 123 Main Street, I'd like to find out if there's any pending litigation. Hopefully you get somebody new, nice, who's going to say, okay, here's what we have.
Mhm.
But yes, the first place is to start with the management company. You could go down to the county and pull records. I mean, that's a pain in the butt. A phone call to me is the easiest way to start. One of the other things you can do is you can look and see what's maybe sold in that complex and call the listing agent.
Mhm.
Say, hey, did you have any issues with this? Just want to make sure that I'm not missing anything.
Mhm.
I think that the community of realtors out here is pretty cool. I think you guys are pretty fair and share information with each other. So those are the 2 places I would start. I would start with the management company, would call them up, or I would call up somebody that's maybe listed some properties in there, or even a buyer's agent, whoever it is. Anything that's sold in there recently, I would
Mhm.
try to look for that. Anything non-condo related?
Mhm.
Anything market related? What's going to happen in the market in the next 6 to 12 months? I don't know. I'm just asking.
So it's like, do you know
I don't know.
You
Yeah.
can answer that.
I don't know. I mean,
Because if you do.
What about
like,
this? What
like
about
again, I'll give you my opinion, but I mean, I don't know what's going to happen. I think that I think interest rates are going to remain low, and that's for a variety of different reasons. I think, not to get too political, but I think the political environment that exists right now is going to lend itself to that. I think that the turmoil that exists over in Europe right now with their banking systems is going to lend itself to that. And I don't want to be Debbie Downer, but I think that the third reason is that we've had a bull market for 10 plus years, and for all you economists on Facebook, we can talk about this later. And it's cyclical. So are we going to be approaching a recession? I don't know, but I don't think it's going to be like 2007, 2008, 2009, 2010, but I think there's going to be a correction, and when there's a correction, generally interest rates stay low. And the fourth piece of it is potential war. Like, I don't want to wish for war, but I mean, what's going on over there with the oil battles, I mean, if somehow we decide to go to war usually helps interest rates. That's a far-fetched one. I know nobody wants war, but so I think from that perspective, money is still going to be affordable. And I also think with an election year, people are going to try to keep things kind of here. Is what it comes down to. So I think we're going to personally have a pretty good coming year. I really do, and I don't know what Lawrence Yen says, in the real estate world, but, just in my personal opinion, the people that I read, I think that the coming year is gonna actually be really, really good. Like, really, really good. I think that this spring is gonna be another amazing selling season. And I think there's gonna be a lot of competition out there again. I think, with low interest rates, you're gonna have a lot more buyers coming out there. So I'm excited about it. I'm really excited. This was a surprise year for us. I know that a lot of lenders this time last year were thinking about what the coming year was gonna look like. And this has turned out to be one of the best years that lenders have seen since the recession. And that's a combination of purchase and refinance.
Because has refinance gone way up?
Over 200%
Yeah.
in the last couple months, from what we've seen. And that's just because we're again at some of the all-time lows
Yeah.
that, we've seen. I'm personally refinancing one of my houses right now, and I didn't think I was ever gonna be doing that. So, I just got a mortgage statement from somebody over the weekend that has 2% fixed. I don't know how we got that.
Wow.
And this was 3 years ago. So yeah, what are some of your opinions? What are you guys hoping for, thinking of? You being told?
I think the luxury market is gonna be hurting.
Yeah. I can see that. I can see
I see a
that.
lot of price reductions,
Uh-huh.
and over 800 to 900,000.
Mm-hmm.
Yeah.
Huge reductions
See, I
there.
see that in homes, but not in the luxury condo market.
Yeah, not in the
Cause,
condo.
just taking something like the Landmark, for example, we've seen homes sit on the market. I sold a home in the Timbers last year, and I thought we did pretty good. We were on the market for 7 months.
Mm-hmm.
Where the average was almost a year in homes over $1 million. But then things, in some of the luxury high-rises, we're still seeing townhomes or condominiums, move in 30, 40 days that are still in the $1 million range. So that was kind of an interesting thing to see. So yeah, the luxury market to me was almost a little bit divided between what type of home it was.
Mhm.
As landmarks, I know that there was a big mess years
Yeah.
ago with all the talking about litigation, and
So
you
what
could not get a
happened-
loan in landmark for
Yeah.
years and years.
Then
and
the
years.
developer hung himself, and he got indicted.
Yeah,
Yeah, and he hung himself in Florida. They think he hung himself or whatever. But then East West came in and managed that and really cleaned things up. They cleaned up all the things that he did, and the only concern there is about a year and a half. Like when we lived there, they tossed East West out and decided to become self-managed, which I'm not sure that was a great idea. But that was just my opinion.
Still yet to be seen.
But yeah, still yet to be seen. So, but we do see there incredible equity growth every year there still in that high-end market.
Cool. Do you know Jim Levy?
Now, name sounds.
Yeah, I think he
familiar.
was here or is here, and I know he used to live in Landmark. I don't know if he still does. So, yeah. Yeah, no, that's interesting. That's really interesting to.
But not just the Landmark. I've looked at some of the other luxury high-rises and seen that kind of equity growth, and then I always look at days on the market, and it's just very, very different days on the market what I've seen between homes in that same price range.
Mm-hmm. That's where actually price per square foot makes
Yes,
a difference.
Yes, absolutely.
Right? Like when you're selling a condo, price per square foot is
Huge.
like gold, as opposed to selling like a house on Highlands Ranch. Price per square foot is not as
And
big of
it's
a
so
deal.
much easier to price out too, when you're doing price per square foot, because you can find units that are exactly built alike. Whereas you go into some neighborhoods and especially depending on how old the neighborhood is, how many people have completely remodeled their home or made additions or anything like that. You just don't see that in the condo world.
No, that's cool. That's cool. There's a lot of new ones going up in the city too right now, with HOAs that are through the roof. Holy smokes, $1,000 HOAs a month.
That's
Yeah, that's what yours is over there.
Over
Yeah.
$1,200.
Hey, but it's a different type of living. It's like.
I always say now my principal interest and taxes are less than what my
That's funny. That's funny.
But you did get a lot, and that's
Yes.
that's how you have to
Yeah.
sell. That's how
Absolutely
you have
got
to
a lot.
sell them too. is
Yeah.
Understanding, you talked about at the beginning. What is your HOA really buying you? It's not just trash removal or something like
Yep.
that. I mean,
And it's a lifestyle. People that are
Yeah.
going to live in the landmark, that's a specific lifestyle that
Right.
you can't get really anywhere else in the tech center, right?
well, really anywhere else,
Anywhere else.
because
Downtown's different,
you're
too.
either downtown
Mm-hmm.
or you're in the suburbs. The Landmark
Yeah.
is one of the few. There's a couple other buildings here in the tech center, but the Landmark is the only one that really is surrounded by shopping center.
Yeah.
That you're not downtown, you're not in the suburbs.
Yeah.
It's a very unique
Yeah.
experience.
Cool. Well, that's all I've got. Hopefully you guys enjoyed this.
Oh, yeah.
Hopefully
Yeah,
it was a
thank
good
you so
use of your
much.
time. If you have any questions, feel free to email, call. I will try to get some information regarding the spot approval and where we're gonna be able to find those, and if it's gonna be able to make things that much quicker on the approval process for the entire complexes. Cool.
Sounds
Thanks
good.
for coming.
Thank you.